I'll just tell you, I used to start presentations to college students by saying, I'm not so far removed from where you are now, but I am pretty far removed from where you are right now. It's even longer than I thought. But I can remember back in the day, as about a sophomore or junior here at Southeastern, I got my first solicitation for a credit card. Any of you got solicitations yet for those? Yeah, a few of you. If not, it will happen very, very soon. And how you make the list, I'm not even sure, but it will happen. It will happen soon. And the same thing that makes you kind of a standout in your sport is going to be the same thing that will keep you out of trouble when it comes to your finances, and that's discipline. Because credit cards are not a bad thing. Revolving debt, which is what we refer to it as in the banking business, is revolving debt. It's not a bad thing, and actually it's a great credit builder. But a person's lack of discipline in dealing with those types of things is what will get them in a lot of trouble. And sometimes it's not even trouble, but sometimes it's just opportunities that you don't get to do the things that you want to do because you've made a mistake. Again, a lot like in athletics. So the handout, we'll talk about a few things there, and then maybe you'll have some questions or whatever. But the biggest issue that I see every single day is an issue called debt to income. Whenever I'm trying to loan someone some money, and debt to income is just that. If you're making $100 a month and you get $90 in debt, that's a 90% debt to income ratio, and that's not good. Typically, for me to make a loan, that debt needs to be at 40%. And we're talking about hard debt. That means car payments, home payments, any type of revolving debt that you have, not your light bill, not your phone bill, those kinds of things. But a lot of times what I'll find is that the things that add up the most, and we'll talk about them in just a second, are the monthlies. And a lot of times they add up at about $25 to $50 each a month, which is the minimum payment that the consumer had to pay on their revolving lines of credit, on their credit cards. They may have, $10,000 in debt on their card, but they're only required to pay about $100 a month, which is the minimum payment that they need to pay. It's about 1%. So, if you look at your handout, average household credit card debt is about $15,700. That's average household debt. Now that's the average household that actually has some type of credit card debt. Okay? So it's $15,000. You can buy a pretty decent car for $15,000. Households, all households included, that's those that don't have credit card debt and those that do. The average is $7,327 in the United States. And that's a whole bunch of debt. Considering a nice round number, right, $10,000, and that's in the middle, kind of in the middle, of those two numbers we just talked about. With $10,000 in debt, interest rate of 10.99, which is about an average. We won't go into a weighted scale of how that's done and based on the prime rate and adding to that to come up with that interest rate. But let's just say 10.99, and that's a good number.
Mark, for some of them might not really understand what interest rate is.
Okay, I'm sorry. Yeah,
and
everything we base our decisions on and rates are based on a number called prime, and the Federal Reserve sets that prime rate, which has been at 3.25%, and that's interest. I spoke to a group, and it's a good observation because I spoke to a group older than you a while back, and I was trying to make a joke. And I said that there is a thing that you do when you come to my bank and we give you money and you pay me back, but you pay me back a little bit more than what I gave you. Do you know what that's called? And I was about to hit a punchline and somebody called it, that's stealing, right? And I said, no, it's not stealing. That's what we call interest. You pay me back a little more than what I gave you. And that's what the interest is. That's how the bank makes its money, on a margin. And so, that rate, that interest rate, that's the amount of money that you pay me back more than what I loaned you. How I'm going to make money. It's how these credit cards make money. And that's a perfect segue, because what happens is at 10.99%, we call that compounding. That interest just keeps on going no matter what. Okay? And what a revolving debt, what a credit card company is required to do is disclose, to tell you all of these things that you're going to have to pay back. In fact, on your statement that you receive now, they're required to tell you that if you just make this minimum payment, this is how much interest you're going to pay over the life of this debt. That's if you don't incur any additional debt. Okay? This is how much you will pay. And this number is staggering to me because the average rate and an average term and at about 1%, you can see that it's going to take you 273 months. Somebody quick, give me the math on that. How many years is that? 20 something. Yeah, there you go. Okay. If you just pay the minimum debt, you're going to be old before you get one credit card paid off. Okay? And as a lender, not this lender, but this lender, how happy would you be? You got somebody hooked for 20 years and you're making money every single month. It's a little bit, but if I know that it's all interest, because you're not touching any of the principal, and the principal is that amount. The principal amount is that $10,000. That's what we call the principal. All right? It's going to take forever. All right? You're handcuffed to this creditor, right? 273 months, and you're going to pay about $17,000 in interest over that period. That's minimum payment on $10,000 in debt. You're going to pay it almost 3 times. Okay? Now, let me stop there and tell you that if you came to me today to borrow money and you didn't have a lot of credit history, when I say credit history, that means you haven't borrowed much money. You've borrowed no money in your life. There are some starter type loans that we could help you with. And then one of the easiest ways to help to build that credit score is a disciplined use of revolving debt. Had a guy call me a couple of days ago and he said, hey, I want to come back in. I want to check my credit again. He had been in my office about a year ago. I didn't encourage him to go get a credit card and go, run up a bunch of charges. But I said, yeah, that's one of the ways how you can probably help yourself out a little bit. Got a card. He did a prepaid card. His credit was very poor, and so what he had to do is he had to actually put $500 in an account. And then this creditor said, okay, here's a card with a $500 limit. If all goes south, we've got your $500. But he could take his card. He would buy a tank of gas a month. He would pay it off. He would pay a bill maybe and immediately pay it off. And so each month he had a charge and a payment. On-time monthly payments is as easy as it gets in order to help build your credit. And we'll talk about your credit score in just a second, exactly what that means. But that is, revolving debt can be good, but you have to be disciplined, right? Does that make sense? Is everything making sense to some degree now? Okay, all right. You can see average outstanding student credit card balances. A lot of students are getting credit card offers. And it's just like I talked about, that 46% is in that $100 to $500 range. And there is the hook. How rude of me. I'm sorry. Let me turn this off. Unless it's my wife. And it's not. It's a good answer, right?
I'll let her know that.
Mm-hmm. Please tell her I said so. Yeah. I'm very, very sorry. Let me turn it off and get it out of the way. Where was I? Yeah, $100 to $500. That's the hook. I'll promise you, if you haven't received an offer yet, when you get the first one, you are pre-approved for up to $500 in credit. And it might not necessarily be Chase, Visa. It might be Gap, Old Navy, those kinds of things. Best Buy, those kinds of revolving debts. And you can see average credit card debt by college grade level in 2013. And anyway, so that's a focus for revolving debt folks, for credit card folks, is they're going to try and get you started. And it's not a bad thing. It's a good thing unless you aren't disciplined in the use of debt. Okay? You guys know Blake Wright down at Taco Casa? He and I spoke to a group of 5th graders some time back, and he said, I can't remember exactly what it was. That's why I put your good name and your credit score. He said there were, I know what it was. I wish I remembered now. He said three things that will get you through life. and will never fail you. He said, you have all those three things, you'll fly right through life. And he said, that's your faith, your good name, and your credit score. and your faith and your good name is the most important. But the thing is your good name helps you establish your credit score. And that's just basically saying, you're loaning me money, or we're doing business, I'm going to pay you back. I don't know when I started or when I have to stop. And I know I'm on camera, there's a time limit, but you guys just wave me down. Credit scores. Anybody know what that is? You know what your credit score is? We have a nice little definition of what that is.
Come on.
Because I'm not sure. I don't really know exactly how to explain it myself. What do you think it is? Anybody ever look at your stat sheet? You know what your stats say? Okay? And your stats say, your shooting percentage, your three-point percentage, your free throw percentage, points per game, all those things. And then, I don't know if coach actually grades you then, after each game, it kind of gives you that grade. But that's what your credit score is. When I look at someone's credit score, it tells me about more than I really need to know about just about anybody. And it's anything that they've ever done. Some things are dated and don't have as much bearing on that credit score, but when someone comes to me and they want to borrow money, the first thing that we need to do, we use TransUnion. You'll see on here, Experian, TransUnion, and Equifax. Those are three companies, those are three credit bureaus that provide information to lenders so we can determine if we need to loan the money or not. And what happens is every single transaction that you ever do, not buying something at Walmart, but buying a car, a home, student loans, all of those things, student loans in particular, you've paid them off properly, your credit score is higher. You haven't done so well, your credit score is lower. My standard response when somebody calls me and says, I'm not sure if I can get a loan or not. Normally, you know what that means? What do you think that means?
Bad credit.
It means they probably can't, okay? It probably means that their credit is really poor. I hear that a lot. I'm not so sure how good my credit is. I'm like, God. Let's just turn that power off. Here we go. New phone. Not really. But I've got a pretty good idea. What I'm going to tell them, and what I tell them is this. And this will make sense to you in just a second when we talk about these numbers. 600 means we probably get to have a little bit of a conversation. 625 means we're kind of trying to find a way to get you some money, but you're going to pay back a whole lot more interest than what you're going to want to pay. And at 700, if you want to finance the purchase of my bank, we'll find a way to get it done if you've got enough income. Because 700 is that magic number. Just remember that. You want to have a 700 credit score your whole life. 800, you can do anything you want to do. And again, that's your stat sheet. That's your grade. All the things that you do work out to what your credit score is. Most commonly used credit scoring algorithm or formula, if you will, is produced by Fair Isaac Corp. And so we refer to those scores as FICO scores. Fair Isaac Corporation, that's what we call them. And then every lender kind of sets their own standards. Every bank is a little bit different whenever they're trying to determine who they're going to loan money to, what that score needs to be. 300 to 629, like I said, 600, we get to have a conversation. And just because, I'll tell you, I had my lowest ever credit score just a few days ago. There are some that I feel led and obligated to try and help them to get themselves in a better position. So at some point, maybe we can do business. And then there are some who have used and abused every single relationship they've ever had, and that's what got them in the position that they are. And I have no problem at all determining that from the credit report and tell them, no thank you. And that's going to happen. But every lender is going to set their own standards. And you want to shoot for what? 700. Okay, good. Very good. All right. Experience, yes.
Say that you've never done anything, you've never had loans, anything, do
Yeah.
you start at 300?
Nope. Nope, actually, there's not really a starting period. You can start with no score. Like if you've never done anything right now, you've never done anything and you come in, I'm still gonna have to pull a credit report. There's just gonna be a blank box there. It won't have a score at all. And we experience that some. So you don't start at 300, unfortunately. That's a good question. It's a very good question, because that's a long old hike. What happens is in some instances for beginning credit, mom, dad, aunt, uncle, good friend, spouse, whatever it might be, a co-signer, someone that will sign a loan for you to get you started. You have no credit. 3 pieces of criteria that I'm always looking for. The first of those is credit. The second is going to be debt to income, like we talked about a while ago. As long as you're not spending too much money, I can probably loan you some money. And then the third is going to be loan to value. Loan to value is in reference to, like if it's a car, I'm going to loan you $10,000 on the car if the car is worth $10,000. If the car is worth $8,000 and somebody's knocking your head off on the deal and making an extra $2,000, I can't loan that much. So loan to value is the third piece of criteria. But the first piece of criteria is the credit. And we got to find a way to do that. In order to establish some credit sometimes, just like with that credit card a little while ago, and it's smart if you have a savings plan, which I hope that you do every single month, whether you're making $100 or whether you're getting $1,000, whatever it might be, sticking some money in savings. One of the things that I do a lot to help young borrowers and just borrowers trying to rebuild their credit is they'll put money into a savings account. Just like the car is collateral for me, collateral, you know what collateral is? Collateral is what I'm loaning money for you to get, okay? Sometimes my collateral, my security in that loan is the $1,000 that I have sitting in the savings account in my bank. And so if you already have money in that savings account, the thing that I can do is I'll say, okay, I'm going to loan you $1,000 because I know that even if you take that $1,000 and you go to, the Caribbean and never come back, what do I still have in my bank? I've got the other $1,000, okay? So I have my security in the loan. But that $1,000, a lot of times, they'll put that money into the account as well, pay it back over a 12-month period. At the end of the 12-month period, quick math says I've got how much in the account? $2,000, right? And I've spent 12 months making what? On-time monthly payments. Which has helped my credit, which has built my credit. It's done nothing but improve it. And I got all this money sitting in the bank. That's a great idea for first-time borrowers to remember. Money in the bank, never been a single penny of insured money in any FDIC. That's our insurer, every single bank. Remember FDIC at the end of every commercial? You've heard it, right? There's never been a penny of that money lost that's insured by the FDIC. So money in the bank is secure. So at the end of that loan, I got that money, plus if I put the other money in there with it, it's still there, right? Does that make sense? I'm talking fast, man. There's a whole bunch of stuff, and I find it interesting. I'm sure you'll may or may not. But my degree was communication. I just ended up being a banker. I was a DJ for like 10 years, all right? I drove the K-Lake Cruiser for 8 summers, and then all of a sudden I determined that the illustrious career as a DJ had prepared me for a career in banking. Go figure that, okay? There was a cool factor at one point in my life. Now I'm just a banker, all right? But anyway, most lenders are going to base their rates to you on your credit score. You can kind of see that on your page there under your good name and your credit score. A lot of times people just call me, Mark, looking at a car, it's about $10,000. I may not have very good credit, which we know what that means, right? It's probably going to be my highest rate. Can you tell me what my monthly payments are going to be? And what this does, you can kind of use some of the criteria to determine on every $5,000 if the rate and the term meaning how long you're going to pay on it, 4.5% for 60 months. If those two things are the same, you can kind of figure when you're out shopping for a car, about every $5,000, you can kind of surmise here that about every, what's that, 33, about $95 to $97, somewhere $90 plus dollars, less than $100 per 5,000. You see what I'm saying? See the correlation there? So if you're looking at a $20,000 car, Okay, it's going to be about $375. You don't have your handy dandy payment calculator in your hand. If you've done your homework before, which I encourage you to do, when you shop, when you bank, when you borrow money, do your homework. Don't let somebody tell you, I can get you a loan, $25,000. It's going to cost you about $560. Well, somebody just killed you on interest and a bunch of stuff on the back end, like Credit Life and Whole Life and all kinds of products that you'll find out about soon enough. But you can figure that if you've done the interest or you've done the homework on a $20,000 loan, you know that about $95 more or less per $5,000 is what you can kind of count on as far as a payment. Does that make sense? Okay, cool. Let me just tell you this. If you go out and do a lot of things on Vantage Score, TransRisk, Credit Karma, Plus, those kinds of things, that's been turned off. How many times, man? Gosh, thank you. You ever see the old plus/minus sign on things? There's a big old plus or minus on all of those. Most every bank is going to use Experian, TransUnion, or Equifax to pull your credit report. Anything else, they're going to take some of the same factors into consideration, but it may or may not be the same. Okay. One thing that you don't have to have a lot of credit to get is a payday loan or just a quick consumer loan. I've got a few friends that work in that right now. Matter of fact, I thought about this on the way down here. Walters, right? Yeah, I'm a Warwick boy. My sister, Olivia, is a giant next to my sister, okay? I got all the size in my family. My sister worked at Rainbow Finance in Waurika, and she managed the place. And I'm telling you, she is a bulldog, all right? Because she is tiny, but some folks don't pay their loans back all the time like they're supposed to. I used to travel a lot with my job, and I would swing by if I was going through there and stop in and see her. And she was always on the phone. She didn't have a customer in front of her. She was calling somebody to collect. And you would see grown men, big guys, walking in the door with their head down to walk over to her desk. I mean, scared to death of her because they had their TV hawked to her for a payday loan or a cheap loan that they could get. And she was ruthless. You know where that is? Been through Waurika, Main Street, kind of fun. Okay, yeah, Cotton County, Jefferson County, they're pretty close. So, but anyway, these things can get you in a lot of trouble because they are not regulated. I mentioned earlier the FDIC, which kind of regulates all the banks in America. A lot of small loan shops are not regulated. They do have to disclose a lot of the interest and a lot of the fees that you have to pay in order to say, hey, I'm going to write you a check today. I get paid on the 1st. I'm going to write you this check for $310, just a $10 fee for this $300. But then there's interest. There's a $10 fee plus tons of interest. In some cases, when you're finished with this loan over the course of a month, 45 days, 60 days, interest can accrue at a rate of 200% and 300%. Okay? Always read the fine print. That's why I made this page so small and put it in a little bitty font. So I thought it would remind me to tell you to always read the fine print. Know what you're getting into. And I'll just tell you, because I think time-wise, as we kind of wind down, there's so many things to tell you about that I see every day that people have done poorly, that keep them from getting all the cool things and all the nice things that they want to do. They want to drive a nice car and they're making plenty of money to do it. They want to live in a nice home and they're making plenty of money to do it. They just want to take a short vacation with the kids in the summer and they make plenty of money to do it, but they can't. They can't do any of those things because they didn't have the discipline with their finances like they did in so many other things. And how many of you have taken accounting? Yeah. I had to take it, like one of you, really, or maybe a couple of you. Debits, credits, ledgers, all those things. It just doesn't excite me, but I'm a banker. I kind of got to do those things. But all you have to know is pretty simple. You can't spend more money than you make, right? And the thing is in order to know how much you're making, how much you're truly, putting in the bank, and how much you're spending, you have to do what? Very simple, you just have to what? You keep track of it. Just keep track of those things. There are plenty of people in business who are good. They want to help you. They want you to get the things that you want to get. And there are far more of those people than there are, shady salespeople, selling pocket watches out of the inside of their coats. Okay? In most instances, those folks that talk about, it's a salesman. He was trying to get me. He's trying to take me for a little more money. Most likely, the deal went south, or it didn't work out for them because they weren't prepared. They were charged a higher rate because what was bad? Their credit was bad. Most likely, most of those scenarios were the consumer's fault. There aren't a lot of people. There are some that are. There aren't a lot of people that are out there to take you for every penny that you've got in a consumer-type transaction, a loan at a bank, buying a car. They're going to take what the market will bear. Do your homework, and it's the easiest process ever. It's still a pain in the rear. And I've wanted to pull my hair out and punch a few folks at a car lot. I worked at one once. But if you do your homework, everything is easy. You walk out on the floor to play Anderson State tonight, you haven't watched any film, you have no idea what they're going to do. You're going to spend a little time wandering through the wilderness trying to figure out how you're going to defend them and how you're going to score against them. It's the same thing with your finances. And I would just encourage you, you're at a monumental moment in your life. Some of your seniors are about to get ready to step out into the real world, and some of you are freshmen and whatever, But in the next few years, your responsibilities are going to just multiply. They're going to increase exponentially. And finances are one of those things. And again, it can either make things possible for you that you never even imagined. You don't have to be making $1 billion a year to live very comfortably and do well with the money that you have. But you got to live within your means, and you have to be disciplined. Okay? Questions, comments, or accusations? Anyone?
How often, on the first page, you talk about the average credit card debt in the United States. How nice is it when someone comes in to borrow money and that they have a big zero on credit card debt? Is that rare?
Yeah.
And how big of a surprise and nice is it for you guys?
Tell you what, on the second page where we talk about credit scores, one of the factors that those three folks use, that the folks at Experian, TransUnion, and Equifax, one of the factors that they take into consideration from those FICO scores is the amount of available revolving debt. It doesn't say, do you have a bunch of revolving debt, that's a bad thing. It's just how much available. If I've got a $10,000 credit card and I've got a couple $100 charged on it, I've got 90+% of that available to me, that increases my credit score. And plus, it makes your banker feel a whole lot better that I'm not having to bail you out of a bunch of revolving debt. That's one of the ways that you can have a better credit score. Revolving debt is not a bad thing if you are disciplined and you use it properly. Pay those things off. And I can tell you this, something Mrs. Webb and I have experience with several years back. We weren't much older than you all are right now. Not so far removed from where you are now, as I said earlier. And we had to consolidate some things. We spent a lot of time swiping cards, man. It was great. It was like free money. Shoes, a fishing pole, and a new bow. And thank you. And then it got to a point where it's like, we can't service the debt. So we buckled down. We figured a few things out, got some other things paid off that we could actually use as collateral. I mean, man, we doubled up payments on a vehicle. And then use it as collateral so we could combine those revolving debts and get them under one roof. And the cool thing is instead of paying $100 over 273 months, we put it under a single loan and paid it off in about 24 months and got out from under that. So there are ways to help you if you get in a bind. Good people that can help you out. And there's always a way to get you out of those binds like that, so.
Questions?
Anything
Someone's
else?
got to have something.
If someone has to take out student loans, does that affect credit score?
No, matter of fact, today, I was talking with a lady, and she's got student loans. Hers are deferred. I think her payments don't begin until 2017. She's actually in grad school. That's the thing is those student loans, they show up on your credit report, you know. And I think I read about the rate. I'm trying to think of how to put this. Bad student loan debt is big. I'll just put it that way. The default rate, that's the word I was looking for, the default rate on student loans is really, really high.
You guys know what default means on a loan?
Going bad on it, not paying it back. And the thing is it's kind of like, oh, I got the loan so I can go to college and get a job. So, you know, I'll pay back if I can. Well, if you can't, the old FICO is gonna suffer because it shows up on your credit report. I see it all the time, every day. So it can help you too, on time monthly payments, and it will definitely help you.
You might explain. You mentioned deferred payments on when you take out a student loan.
I have student loans. How many of you have any of you have student loans? Anyone? Lucky you! Wow, man, you're great. But basically they're deferred. It's like I borrowed money on a student loan, and then school was out, and the government program that makes those student loans, they say, you know what, we're going to give them a little bit of time to get a job, gainful employment, and then then they can start paying them back. And so her graduation is supposed to be in December. She's actually going to go to graduate school, but her deferred payment, it's deferred for 2 years. It's not supposed to start until December of 2017. So they back off of that a little bit and give you some time to.
In other words, the government's paying your interest.
Yeah.
On the loan is what they're doing.
Yeah. Okay. I'm sorry about my phone today. I don't know what exactly happened. I'm not sure why I can't turn it off either. But I apologize for that.
Last thing I want to have, not necessarily a question, but it's an emphasis is, you talked about payday loans. You know, he was talking about the credit card might be 11% interest.
Mm-hmm.
If you guys heard what he said on payday loans, they can be 300%. Well, they can be a lot even higher than that, but they can be 300%. Think about that. That's a massive amount of interest that you would have to pay off on a payday loan.
Yeah, if you get time, read the scenario on that back page today, and it'll kind of give you some of that. There is some truth in lending acts that all lenders have to abide by, which means they have to disclose to you what's going to happen. They don't necessarily have to give you all the math. The rate that we're charging you is this. The fee that we're charging you is this. Every loan that I do, I charge an $80 loan fee. Okay? Standard term right now on a vehicle loan is 60 months. Okay? So a little over $1 a month basically is that standard loan fee. $80 Shamrock Bank loan fee. Typically, the standard payday loan fee will range anywhere from $30 to $100, and the loan is typically a few $100s, and typically the term of that loan is about 30 days to 90 days. So if you do the math, which I'm not, you took some accounting classes, maybe that can help us out here, but you figure that a $50 loan fee, interest is calculated annually. So if you do the math, $50 on $100 loan, $50 fee that's paid back in 3 months, there's 12 months in a year. Technically that would equate to $200 in a year. You follow me? If it was an annual loan. On a $100 loan, and it happens. Paying a $50 fee on a $100 loan, you don't have to pay the fee until you get your money to pay the loan back. If I can just get the $100, it gets my cell phone bill paid. That's all folks are worried about. Getting the money right now. I'll pay the $50 for it. But you figure that, there's 200% right there. You just in the fee alone, not even an interest. So the the APR, annual percentage rate that has to be disclosed, there's 200% right there, just on a $50 fee, plus whatever actual interest you're paying. Your APR is 400 or 500%. Your APR meaning the annual percentage rate, interest rate.
Which is high.
That's way up there. Yeah, that's way up there. I would never charge you that much to share my bank.